Many investors will use bonds as ballast for their portfolio. During their lifetime, these tradable debt securities will provide regular income in the form of coupons paid in a preset amount at a predetermined time. That's why bonds are known as fixed income after all. Unless the issuer of the debt gets into trouble, the original investment or principal will also be repaid when the bonds mature. Equally, portfolio builders may own bond funds for similar strategic reasons. Now, a period of low, unchanged interest rates and very subdued inflation may have tempted many people to simply buy bonds and forget about them. But if this situation changes, then fixed income could suddenly become a much more volatile arena. The price of bonds, and indeed bond funds, could swing around a lot more and potentially leave holders with capital losses that exceed the value of the coupons on offer if an investor is obliged to sell at the wrong time. Now, equally, fixed income investors and bond fund managers may see any price swings in bonds as an opportunity, a chance to get access to coupon payment streams at price levels that are so attractive there's a chance to make some capital gains too. Hello, I'm Russ Mould, AJ Bell's Investment Director, and I'd like to briefly talk to you today about the wild volatility we've seen in the bond market this month. Now, the first chart shows the yield on the UK, US and German 10-year government bonds. Now remember that with a bond, just like a share, when its price falls, its yield rises, and when its price rises, its yield falls. Well, yields have just shot higher, so prices have been going down, and the second chart here shows you by just how much. Look at it closely. The UK 10-year has fallen by 5% in price, the US and German equivalents by 4 and 5% since their respective peaks. Such falls therefore wipe out a couple of years' worth of coupons in one fell swoop in Britain and America, and a few decades worth in Germany, assuming the holders have to sell now for any reason. Now, bond yields normally rise for one of three reasons. First, investors are frightened that the borrower, the issuer of the debt, may not be able to pay the coupons and return the principal on time. Default. Second, the market decides interest rates are about to go up. Now, that may make the coupons available on existing bonds less appetizing, so people will start to sell their current bond holdings to make way for paper with a higher coupon. Third, the market decides inflation's about to go up, also making the attractive the coupon on currently available bonds less appetizing, at least in real inflation-adjusted terms. So again, investors potentially start to sell current holdings to make way for new ones with a higher coupon. Now, at the moment, I'm not sure anybody's really accusing the US, UK or Germany of being close to default. Second, the European Central Bank is running a quantitative easing programme until at least September 2016, and it's therefore still easing monetary policy, not tightening it, and neither the Bank of England or the US Federal Reserve seem to be rushing to hike borrowing costs either. That leaves us with just inflation. Oil has bounced, copper too. Throw in interest rate cuts in China, QE in Sweden, and central bank moves to lower borrowing costs in more than 20 countries this year, plus some improved economic momentum in Europe, maybe the market is thinking deflation is not the problem and that inflation is the next big issue. Now, that might seem a bit far-fetched given where inflation is now, minus 0.1% in the UK, and particularly given, but don't forget, the Bank of England, US Federal Reserve, European Central Bank, Bank of Japan, all target 2% inflation. If they succeed, current bond yields will not compensate holders for that risk, or barely in the case of the UK and the US, and potentially leave the coupons worth less in real terms. The fourth option is that bonds had simply become overbought and overvalued, especially in Germany, where the 10-year yield sank to just 0.05% at its peak. Now, a snapback in this context could be healthy, especially if trillions of euros worth of Eurozone bonds offered a negative yield according to bond fund manager PIMCO. It only makes sense to buy a bond that offers you a guaranteed loss, albeit a small one, if you think everything else is about to go into hell in a handcart. So we'll see. Now, for the moment, the bond market volatility has not impacted stock markets, even if May's action has inflicted pain on those who are buyers of government bonds at the top. Whether you own bonds or a bond fund or not, you do need to keep a lookout here though. If the yield on the 10-year gilt, the UK government bond headline, ever rises back above the 3.5% currently in offer from the FTSE All-Share Equity Index, some investors may start to prefer the calmer waters of fixed income to the rough and tumble of equities. For the moment, that still seems some way off, with a yield on the 10-year gilt at 1.9% as I sit here right now. It's something to keep in mind for the future anyway, and thank you for watching, and I look forward to seeing you next time.